When a business sets up a retirement plan like a 401k plan or another plan, there are supposed to be some tax benefits. But what exactly are those benefits, those potential benefits, and who receives them? Hi, I'm Justin Pritchard, and we're going to cover two ways that individuals and businesses can potentially benefit from having a workplace retirement plan. First, you have the benefits that can go to the individuals or the participants in the plan. These are the people that might be saving money in the plan, including the business owner who might contribute to the plan for their future retirement. So, first of all, you save up some assets for retirement, and that's always helpful so that you have something for later. But there may also be some tax benefits for individuals as well. One option for saving in those plans is to make pre-tax contributions, what you might call traditional retirement contributions, and those would lower your taxable income by the amount that you put into the plan. And that can help you reduce your taxes today, whether or not you're eligible to get a deduction on your IRA contribution. You should be able to receive that reduced income if you use a 401k plan, for example. If you choose to make after-tax contributions, there can be some potential benefits there as well. You don't get a break today on the amount that you put in, but if you follow all of the IRS rules, you can potentially have tax-free growth in those accounts. And what that means is that when you take the money out of those accounts in retirement, all of it could potentially come out tax-free. So that includes the contributions that you made, as well as any growth that happens on top of that, any interest or earnings that happened in the account. The ability to save in those accounts can be really helpful for some people. For starters, given your income, you might not be able to make a pre-tax contribution to your IRA. In other words, maybe you make too much to be able to deduct that contribution on your tax return. Likewise, you might be ineligible to make Roth contributions, again, in an IRA, but in a 401k, for example, you would be able to still make those Roth contributions if the plan offers Roth 401k. So there's some significant savings possible. In 2019, you can contribute up to $19,000 of your own pay. So that's your salary deferral contribution. On top of that, the employer can potentially make profit sharing contributions or matching contributions. So that can even be on top of the $19,000 of the employee contribution. But what about the business? How does the business benefit? A retirement plan is an employee benefit. So if the business is paying expenses to offer that benefit, those can potentially be deductible business expenses. So that can help some business owners. Now you need to verify with your CPA what you can and cannot do, but in some cases, that's helpful for a business. So you've got the administrative costs that you pay for running a plan. And in a second, we're going to talk about a tax credit that you might get for that. There are also employer contributions to the plan. So if you do profit sharing contributions or matching contributions that go into employees' accounts, those may also be deductible to the business. So that helps to reduce the business's profit. Now, what about that tax credit? The IRS wants to help small businesses offer retirement plans. So if you have 100 or fewer employees and you meet other criteria, you need to check with your CPA on all of these things. You may be able to get a tax credit based on the administrative expenses you pay to offer the plan. So those might be startup costs. They might be fees that you pay to a third-party administrator, a TPA, for example. Currently, that tax credit is up to $500 per year for 3 years. So that's a potential credit of $1,500. And remember that a tax credit is more valuable than a deduction. You might be saying this sounds like a lot of expenses and I'm just lowering my profits, and why would I want to lower my profits? Well, you may still come out ahead even if you spend money on a retirement plan. For starters, you as the employer or the business owner get to make contributions for your own retirement. So in a lot of cases, business owners don't qualify for very meaningful retirement contributions. But if you set up a plan through the workplace, you may be able to save quite a bit more. You're also offering a valuable benefit for your employees. So if you want to make your workplace a competitive place for high quality employees and reward them for the work that they do, having a workplace retirement plan is helpful for that. So there are certainly expenses to offering a plan. You have those administrative expenses potentially. You might have employee contributions that you have to make. But in some cases, you can possibly come out ahead. So you get to save quite a bit for yourself, and some of the benefits offset anything that you put towards administrative expenses or to employees. So I hope that gives you a slightly better idea of how a business can benefit from setting up a retirement plan. Yes, there may be some expenses, but there are also some potential tax benefits, and there may be some other benefits like making your organization appealing to employees. Please remember, I'm not a CPA or a tax advisor. Check with your CPA on all of these details. One thing to remember about making pre-tax contributions is that you do have to pay those taxes eventually. So typically you pay it when the money comes out of a retirement account, and you don't know what the tax rates will be at that point in time. So it could work out in your favor, or it might work against you. And the same is true for making Roth contributions and getting the taxes out of the way today. You just don't know for sure if it's going to work out exactly the way you hope.